Welcome, YouTube family. Welcome to another edition of the Kevin Strong Show. I do apologize for the late start. I had problems. I had to reach out to my broker. They're doing some technical maintenance or some updating on the platform that I use. So I'm going to have to modify that a little bit in regards to this small account challenge. But what a rocky week. So we're going to talk a little bit about is obviously the housing data that came out that said we had over 300,000 jobs. I posted some things about that on Facebook. I think the unemployment and job data is just crap. I think it's just a lot of part-time jobs getting aggregated into the data. And I think one report came out last week that says we haven't had a net full-time gain in jobs in almost a year. So the large majority of the job growth that is being reported is part-time work. We all know that people are having to deal with 2 and 3 jobs to make ends meet. We're constantly hearing about large employers, local and nationally, laying off thousands of workers, but for some mysterious reason, this information is not working its way into the unemployment data. So without further ado, let's go ahead and get into this. I have a lot of information I want to share with you. It was a really challenging, tough week, especially if you are heavily invested in the tech stocks, which hit me kind of hard. So I had to do some really aggressive trading to try to rebound. But as promised, I promised you transparency, and that's what you're going to get. So without further ado, we're going to do a little lesson, something called the MACD. And we're going to kind of go into that, explaining what that is. And even if you're a basic trader, don't understand all of the candlestick patterns, or if you don't understand the lines and the graphs, this is a very simple way to learn how to get in and how to get out of a trade just using one technical indicator. So without further ado, we're going to jump into that, and then we're going to go into the account, and then I'm going to finish the video talking about whether or not I was up, or as Caesars used to say, up, down for the account. So let's go ahead and start off by talking about what is the MACD. It is a moving average convergence divergence, hence MACD, is a technical indicator to help investors identify price trends, measure trend momentum, and identify market entry points for buying and selling. So it's a good data point, so to speak, to let you know where a certain particular stock price is headed. Is it consolidating, kind of moving up and down and not really going in any direction? Or is it clearly going up? Or is it clearly going down? So what is the MACD signal? It basically is a line. It's calculated by subtracting what's called, and this is going to sound technical, but just hold on for me. For you guys who are visual learners, I'll help you out with that. The MACD line is calculated by subtracting the 26-period exponential moving average, that's what EMA stands for, from the 12-day period exponential moving average. The calculation creates what we call the MACD line. So there's a formula. Basically, you take the 20-day period of what the stock, how the stock has been moving, subtract that basically from the 12-day period, how the stock has been moving, and that basically gives you an idea of how they come up with the MACD. So what does a MACD look like? So right here, folks, this is a MACD line. This is something called the signal line and divergence. We're not going to get into all that. Like I said, I'm going to really try to keep this simplistic. So you see my mouse here. When the blue line is higher than the red line, that's normally, not always, that's normally an indication that stocks are going to go up. Once again, when the blue line is higher than the red line, that typically indicates that the stock is going to go up in value. Not always. You get something what's called a false positive. And if you've ever been on the Maury Purpose show, or whatever the hell that show's called, I'm sure you like those false positives. You are not the father. But anyway, I digress. You know me, I got to throw some humor in there. So blue line over is good. When it goes below the red line, it is bad. So let's look at this. As the blue line is up right here, you see my mouse down here in front of May at the bottom. Follow my mouse all the way up, and when the candle starts to turn, looks like green, which is go, which is good, red is bad, this is confirmation that it's actually working. So as you can see, as this line is trending well above the red line, so is the stock price. There are people who purely trade just using the MACD and do quite well at it if they don't understand anything else. I don't recommend that. Like I said, this is not financial advice, just for educational purposes only, but it is a good starting point if you want to learn how to trade. As you can see, when this blue line starts to go below the red line, this hasn't moved down that much. This is why I said, even though this is confirmation that the stock price is on its way down, it may not happen immediately. So you got to kind of look at the MACD, but also look at the candlesticks to see if you get confirmation for that. And as you can see here, this takes a long time because this is in what they call a consolidation period. It's just moving up and down in a small range. And then it finally breaks down aggressively, big volume. And as it aggressively swings down, so does the MACD aggressively swings down. It bottoms out down here and it's not really doing anything. And that also is reflected right here. It's in another consolidation period. See that? It's not really moving up. It's not really moving down a lot. And then as we can see here, as the MACD comes up positive, so does the candlesticks start to go above. So that's a very simplistic way of looking at the MACD as one technical indicator as to how price may move either up or down. As you can see in this example, sometimes it can consolidate. So you can try this starting next week. You know, pick a stock that you like, Apple, Tesla, whatever, and look at the patterns. You don't really have to understand anything. The green candles is good, the red candles is bad, and you're just going to follow that MACD and say, hey, when the MACD goes above the red line, I'm going to see if those candles start to go up. When the MACD starts to go below the red line, or in this case, this blue line goes below the red line, I'm going to see if those candles start to go down. That's a very, very simplistic way of understanding it. I hope you guys are getting some value out of this because you can trade profitably using this technique. So now what I'm going to do is go over some examples of how this MACD thing could actually look on a real chart pattern. So let me go ahead and stop sharing my screen here. Hope you guys are understanding this. I'm trying to really keep this in a very simplistic way. Let's see. That is not what I want. All right, hold up here. Sorry about that, gents. I'm going to stop and we're going to go to the other one. That's what we want. Okay, this is a chart of. Can you guys see that? Hopefully pretty good. So you see where my mouse is right here? This might be really hard to see. You see this blue line that we just talked about is above this red line right here. It may be really hard to see, but you can see this. And guess what? The candles are green, and look at that. It's going all the way up. And then when this blue line goes a little bit below the red line, guess what? The candles turn red and it went down. This kind of continued to go up. This is kind of like a riding pattern. It's not really doing much. So like I said, this is not a one-stop shop indicator as to say, just solely go with this, because if you do, you can be right quite a bit, but you could also get some false positives because it's kind of riding along here, but it's not really going up and down despite the stock still going up. So you gotta kind of monitor both. And as you can see here, now that the blue line goes below the red line, guess what? The stock candles turned red and the stock started to go down. And rinse and repeat. Blue line up, candles up. Blue line down, candles down. Rinse and repeat. And remember last week we talked about double tops. So you see up here, we almost have 3 peaks almost at the same level. This third one is a little bit lower than the first, but clearly this third peak is not as high as this peak. So this is an indication that the stock is also still trending down, even though you're getting some patterns in between where you can trade and make profit. Once this third peak basically peters out and says, oh, I just can't get any higher, it was a violently swing to the downside. Also indicated by the MACD going below the red line and then going up. So Tesla is a really, really hard stock to trade. We talked about this last week. This is the 10-day moving average. I'm not going to go over that again. This thick line here, this orange line, is called the 200-day moving average. For those of you who don't understand that, anytime a stock goes below its 200-day moving average, that's normally an indication for significant push to the downside. Because for a 200-day moving average is that the stock is maintained at or above that price point for 200 days, well over 6 months. So once it goes below that 200-day moving average, not always, it typically can be an indication that there's going to be significant more downturn. But that didn't happen, as you can see right here. It went below the 200-day moving average. So a lot of people might say, oh, I'm going to short Tesla. And it faked you out and went right back up. And that's what they call a short squeeze for some of you who are a little bit more advanced. So that's all I'm going to do. Like I said, I'm going to give you bits and pieces, but start off by looking at the MACD, picking out a stock, looking at the candles, and seeing if the candle patterns are matching the same way the MACD is going up or down. Okay, I know this is getting a little long in the tooth. So now finally, last but not least, I was not able to upload my Thinkorswim platform to kind of show you the balance. So we're going to have to go to a different screen to take a look at that. All right. So let me explain this. So really, really choppy week. I got caught sideways a little bit with Tesla. Reuters came out with a report that said that Tesla was scrapping their low-cost cars. That brought the damn stock down by 3.6%. And I was in a trade hoping that Tesla would go up. When that news came down, guess what? It went down. And then I said, okay, now I'm going to put on a trade saying that's really bad news. So I guess Tesla's really going to go down even more. So Elon Musk and his crazy ass, he comes right back out and fires on Twitter. Oh, that's a lie. That's bullshit. And then the stock started to go back up. I'm like, shit. Huh? So I decided to say, you know what? I'm just going to let the market settle down. I'm not going to sell my bear position, which basically saying I'm predicting that the stock is going to go down, even though Eli refuted Reuters report. And the stock came in a little bit below where I wanted it to be at around 165. So I think I lost like about $20 on it. Okay, getting to the account. So the account started off at $4,000, as you guys know. And as you can see here, it's at about $4,200. Don't worry about this gains and loss because this is taking into effect 2 trades that I have on right now. NVIDIA and SMCI, which is a super semiconductor trade. So for those of you who don't follow stocks, I've got a current position with NVIDIA that as long as NVIDIA is at $870 a share by next Friday, and it's at $880 now. I think I'm going to make like $345 on that max, and then this other one has to get to $1,000. It's at $948. So right now, technically, it's showing that these trades are losing, but NVIDIA is in a very, very strong position. This really doesn't represent the value of the account because this is taking into consideration if both of the 2 trades that I have now are good, and I get 100% profit on them, which is going to be unlikely. So I'm being realistic with that. So let's just go with about $4,100 when it's all said and done. Okay, $4,140, say $4,200. So this is what I'm getting at. Here's my point. So like I said, the challenge was to get this thing over $25,000 in 120 days. It's going to require a lot of aggressive trading. I could blow this account up. What blowing up an account up means basically is that the account goes to zero because I have to do aggressive trading in order to get the account to that value in such a short period of time. If I was doing it in a more systematic, more conservative way, at a slower pace, then I wouldn't have to be as aggressive with my trades. So let's just take the worst case scenario. Let's say this thing's only at $4,100, right? Think about this now. So that's $100 a week. So what's 100? Say I'm only doing $100 a week. 100 times 4 is what? $400, right? And $400 divided into 4,000 is 10%, right? So even at $100 a week, if I maintain this same profit trend at just $100 a week, by the end of the calendar year, by April of 2025, this account will double, will more than double. I'll get 100% on my money. So this is why trading is very difficult. It's not easy, but we're going to go ahead and take a stab at it, and I'm going to see if I can get this thing to its desired level. So this is getting a little long in the tooth. I'm going to go over and show you how many trades I made and what my percentage of winnings and losings are in relationship to the first week of this challenge. So let's go ahead and stop the screen here. Sorry about this, guys, but I hope you're really getting some value out of this. If you are, hit that like button, comment, and share because I care. So this is called Trader View, if I can pull this up here. Okay. And let me go to Trader View. And I'm going to see if I can really blow this up. Yeah. You guys can see that. So in conclusion, like I say, transparency. 2-to-1 ratio, average trade, largest loss, largest gain. What saved me this week was Meta. I put on 3 option contracts. I went really, really hard on Meta. And the day before I did that, and then Meta popped. And I think I made like 60% return on that overnight. So as you can see, my winning trade rate right now is 83%. I think I did about 13 trades and only lost 2. It was a small loss to Tesla, I think at $20, and there's another one that I got in and out of real quickly. So sorry I couldn't show you the other platform because Thinkorswim is actually updating, but this is a really, really good, respectable rate. So understand that when you're trading, guys, the key to this thing is that you just have to basically do a lot of trades. It's like flipping a coin, right? When you deal with options and you set up probabilities of typically around 65 to 70%, you have to put on a lot of trades in order for that probability to work itself out. And that's why so many people who start trading think it doesn't work. For example, if you flip a coin, right, you can get heads 5 times in a row. Well, that's the same thing with a stock if you don't position yourself for a high probability of success. So what do? You say, shit, I've done this 5 times. I've lost money all 5 times. So I'm getting out of this business. But the law of averages works itself out. So if you were to flip that coin probably 200 times, you'd probably be around 51-49%. The average would work itself out. It's the same thing with trading. So when you're doing with options trading, which is different from swing trading, but what I'm saying is that most of my options are basically at a 65 to 7% probability. So as long as I'm structuring the trades the right way and do a lot of volume, the numbers will take care of themselves. So like I said, even if I only maintain a $100 profit per week on a $4,000 account in a 1 calendar year, that account would double. So what if I had 10, 15, 20, 50, or $100,000 and I was doing it? You see the power in this? It is not easy. I'm not dismissing that. Very few people are profitable consistently in the long-term trading, whether they're day trading, swing trading, or options trading. So once again, I'm not giving anybody any financial advice. If you are risk adverse, I still recommend, in my humble opinion, this isn't financial advice, you should be buying 4-week T-bills, rinse and repeat every 4 weeks. So at least you're mitigating inflation. So hopefully by next week, I'll have this account up significantly higher. We'll see what the semiconductor stock and NVIDIA does. I'm very optimistic about that. And I plan on putting on quite a few trades next week, probably another 10. So hopefully by this time next week, we're going to be looking at around 20 trades, but not bad, not good. It was a really, really tough week, especially when that jackass from the Fed came out and says that, oh, I don't think we're going to have any rate cuts or maybe 2 rate cuts. That basically put a wet blanket all over the tech. And that's what took a significant drawdown on my account. And then I had to go heavy, as I said, on Facebook in order to rebound. Because when I initially started this thing, it was at like 4176, and it's only a little bit higher than that. But it was a really, really, really challenging week. So we're at the 20-minute mark. Once again, if you have stuck with me this long, I really appreciate it. Please do me the honor of commenting. Please hit that like button so YouTube will circulate my content. And if you think somebody could benefit from learning this way how to trade, because I'm keeping it really simplistic, please share the video. Once again, don't forget to look at this MACD, because we're going to build on this theory of basic swing trading every week as I give you insight into the small account challenge. Thank you for tuning in to the Kevin Strong Show. I'll see you in the next one, and have a great weekend.